know you're going to learn a lot watching this video.
This is Chapter 14 of Accounting 202, Managerial Accounting Concepts and Principles. In this recorded lecture, I will review the highlighted learning objectives. So first we'll look at the purpose and nature of managerial accounting. Managerial accounting provides financial and non-financial information to an organization's managers. So managers such as heads of marketing, information technology, and human resources, and of course top-level managers as well, including the CEO and CFO. So in this course, we will be looking at managerial accounting, and we will also compare it with financial accounting. So next we're going to look at the different types of cost and how they can be classified. Cost can be classified as either fixed or variable. A fixed cost does not change with changes in the volume of activity. An example would be straight line depreciation on equipment. Variable costs, however, do change in proportion to changes in the volume of activity. An example is sales commissions, which are computed as a percent of sales revenue. We can also classify cost as either direct or indirect. A direct cost is traceable to a single cost object, and an indirect cost cannot be easily or cost beneficially traced to a single cost object. You can see examples of direct cost, which would include the materials and the labor in producing a product. Examples of indirect costs would include maintenance expenditures, which would benefit multiple departments. So now we're going to look at product and period cost. A product cost includes the cost necessary to create a product, and it includes three primary costs: direct materials, direct labor, and factory overhead, also called manufacturing overhead. Overhead refers to the production cost other than direct materials and direct labor. Period costs, on the other hand, are non-production costs and are associated with activities linked to a time period as opposed to linking them with a product. Examples of period cost include the salaries of the sales staff, wages of maintenance workers, advertising expenses, and depreciation on office equipment or office furniture. Period costs are expensed in the period when incurred as either selling or general and administrative expenses. This shows the different effects of product and period cost. Period cost will flow directly to the income statement as an expense, and you can see that in the upper portion. So period costs go to the income statement. Product costs are first assigned to inventory, and you know that inventory is an asset. Their final treatment will depend on if the inventory is sold or if it is still in ending inventory. Product costs assigned to unsold inventory are carried forward on the balance sheet because it's an asset. And then when it's sold, it's reported as cost of goods sold. So here's product cost. When it's sold, it goes on the income statement. When it's left in inventory, it goes on the balance sheet. These cost concepts also apply to service organizations because they are looking primarily at direct labor and overhead costs. So there will be some differences because service companies, for the most part, do not have a product, but they still will need to keep track of their costs, which again will include primarily labor, and overhead. Direct materials are the cost for the materials that are separately traced through the manufacturing process to finished goods. Examples of direct materials in a manufacturing of a mountain bike would include the bike's tires, seat, frame, pedals, brakes, cables, gears, and handlebars. Direct labor refers to the employees who physically convert the materials to a finished product. Direct labor costs are the wages and benefits for direct labor that are separately traced through the manufacturing process to the finished goods. Examples of direct labor in manufacturing a mountain bike would include the operators directly involved in converting the raw materials into finished products. So that would include those working in welding, painting, and forming, and assembly line workers who would attach the materials such as tires, seats, pedals, and brakes. Factory overhead, which can also be called manufacturing overhead, consists of all manufacturing costs except direct materials or direct labor. Factory overhead costs are not separately traced to the finished goods, and they include indirect materials and indirect labor. Indirect materials are components used in manufacturing the product, but they are not clearly identified with specific product units. Examples would include screws and nuts used in assembling, and staples and glue. Indirect labor refers to the cost of the workers who assist or supervise in the manufacturing process. So their labor is not clearly identified with specific product units. Examples include those who maintain the manufacturing equipment, so maintenance workers, and salaries of the production supervisor. Other indirect costs could include the factory utilities, factory rent, depreciation on the factory buildings and equipment, factory insurance, property taxes on the factory buildings, and factory accounting and legal services. We can classify product cost into prime or conversion. Prime costs are the costs directly associated with manufacturing the finished goods. So that includes direct materials and direct labor. So these two combined are prime costs. Conversion costs are the costs incurred in processing a raw material into a finished good, and so that includes direct labor and manufacturing overhead. So notice that direct labor is considered both a prime cost and a conversion cost. We also have non-manufacturing costs. So these are our selling and administrative expenses. And remember, I mentioned before that they're called period costs, and they are recorded on the income statement when incurred. So in the same period they're incurred. They're not part of the product cost. Examples include office employee salaries and depreciation on the office equipment, also advertising expenses. So now we're going to look at the balance sheets and income statements and compare a merchandiser from a manufacturer. So a merchandiser, which you learned about in Accounting 201, buys finished goods and sells finished goods. But a manufacturer buys raw materials and then converts them, produces them into a finished product, and then sells a finished good. Manufacturers have 3 inventories instead of a single inventory called merchandise inventory. So the 3 inventory accounts for a manufacturer include raw materials. So these are the materials that we just purchased and they're waiting to be processed. Work in process inventory. These are partially completed products. and finished goods, which obviously are the completed products. They're ready to be sold. This compares a balance sheet of a manufacturer and a merchandiser and a service company. So this first one is a service provider, and you can see that they do not have merchandise inventory. This one is a merchandiser, and they have merchandise inventory. And this is an example of a manufacturer, and they have 3 inventory accounts: raw materials, work in process, and finished goods. Next, we will look at computing cost of goods sold. So what you learned in Accounting 201, that for a merchandiser, you have beginning merchandise inventory, you add the cost of the goods that you purchased, subtract the ending merchandise inventory to get cost of goods sold. But for a manufacturer, they have beginning finished goods inventory, add the cost of the goods manufactured, subtract the ending finished goods to get their cost of goods sold. This shows the cost of goods sold with numbers for a merchandiser and a manufacturer. Next, we will look at the flow of manufacturing activities. So we start with our raw materials. We would add, this is our beginning inventory, and then any purchases are going to be our raw materials. Then as we use them, we put them into work in process. Now, work in process usually will have a beginning inventory. We will add the direct materials and add the direct labor and factory overhead. When we finish them, they will come over here into the finished goods inventory. So this, we would also have most likely beginning finished goods inventory, and then we would add the cost of the goods manufactured. When they're sold, they will go as cost of goods sold on the income statement, and if they are not yet sold, they will be on the balance sheet here as finished goods inventory. Now we will look at a schedule of cost of goods manufactured. So we will have our 3 manufacturing costs: direct materials, direct labor, factory overhead. We would add our beginning work in process, subtract the ending to get the cost of goods manufactured. So this is the manufacturing statement for Rocky Mountain Bikes. So you'll see the 3 sections I just mentioned. And this is a breakdown. So beginning inventory, add the purchases, together they equal the available for use, subtract the ending, and that gives you the direct materials used. Here's the direct labor. Factory overhead includes all of these items. Add them together to get the total factory overhead. These 3 are the total manufacturing cost. Add our beginning work in process inventory, subtract the ending work in process inventory, and that gives us our final number, which is cost of goods manufactured. So this details each of the sections. And this shows the flow of cost across the accounting reports. So this is the schedule of cost of goods manufactured, okay, which is the one we just looked at. And here is the income statement. So the cost of goods manufactured comes here, and it's added to the beginning finished goods inventory. The ending finished goods inventory is subtracted to get cost of goods sold. And then over here in the balance sheet, we have our 3 inventory accounts. And notice that the finished goods inventory is also part of the income statement to get the cost of goods sold. This concludes the video lecture of Chapter 14.